Thanks everyone for joining today. So Newcore Gold, we're advancing the Enchi project in Ghana. It's a district scale exploration project that's fundamentally underpinned by a very robust PEA that we think will re-rate the stock in the coming months as the market starts to properly price in the value of the PEA that we put out. I guess first thing I'll highlight is I think I've already made some forward-looking statements and I'll be making more of them. So I'd encourage you to go and read that. In terms of the PEA that we recently put out, it's outlined some very robust economics. We've seen about 12 million shares of the stock trade in the last two and a half weeks, and the stock's up about 60%. So the market has started to recognize the value of that study. But again, our view is there's a fundamental re-rating to come. In terms of the company, we're very well aligned with shareholders, management, and board. We own 22% of the stock, and that's money that we've invested alongside investors over a number of years. We'll get into the PEA in some detail. And then Ghana. Ghana is a tier 1 jurisdiction to be operating in. We sit on a belt with a number of multi-million ounce projects, and we've got true district scale across our project. April 25th, we put out our updated PEA. As I mentioned, we've had a good initial response from the market, but we see a significant re-rating to come. What we outlined within that PEA was a very simple open pit heap leach project. We used a base case of 1850 for that study. And at an 1850 gold price, you're looking at an after-tax NPV of $371 million. That compares to a market cap for Newcore today of roughly US 40 million. So that would have you at just about, just over 0.1 times the NPV of the project. As we get into it in a bit more detail, you'll see why I think that, there's a significant re-rate to come from here. After-tax IRR of 58. And one of the things that really helps drive that is the fact that we've got very low CapEx for the project. Heap leach projects, as most of you would know, require a lot less upfront capital. Under a 2-year payback, just over $1,000 all-in sustaining cost, and a very nice production profile of 122,000 ounces per year over a 9-year mine life. As we continue to walk through these numbers, I think it's also important to recognize who did the study for us. So we worked with Lycopodium. They're the gold standard in Africa for delivering projects and building projects. If you look at the last dozen odd projects they've been involved in with the likes of B2, Endeavour, Newmont, they've all either been on time or ahead of schedule, and on budget or under budget. So these are very robust numbers that we've presented, and obviously partnered with Lycopodium should give you and everybody else a lot of confidence. In terms of the mine itself, we're looking at 8.1 million tons per annum onto the heap leach pad. No pre-stripping, so again, that helps from a capital perspective, and a low strip ratio of just under 2.7 to 1. In terms of production profile, 122,000 ounces over the life of the mine. In year 6 is where we have our peak production of about 150,000 ounces, which is driven by some higher grades. We then have crusher installations that come in years 4 and 5, which increase the all-in sustaining cost a little bit in those years. But ultimately, over the life of the mine, we're at just over $1,000 all-in sustaining cost. As I mentioned, we do have district scale exploration across our project. All of our deposits remain open along strike, so systematically stepping out and adding oxide transitional material, something we'll continue to do. And ultimately, our view is that, this mine will extend well beyond 9 years, but our focus, given how robust the project is to push it towards a production decision at this stage. Really nice cash flow profile at 1850. You're looking at 524 million of after tax. At spot price, you're looking at 855 million. From a sensitivity perspective, and one of the things we've been doing is challenging the market to find us a project with better economics than what we've outlined here. The numbers I've been talking about have all been run at a base case of $18.50. One way to look at it is for every $100 move in the gold price, we're adding roughly US $50 million to our NPV after tax. So for every $100 move in the gold price, we're more than adding our market cap today. When we look at recent trading of $23.50 for gold, you're looking at an after-tax NPV of 630 million. After-tax IRR of 92%. And just over a 1-year payback. So again, I would challenge any of you to go and find a project that has better economics than this. We haven't had anyone come to us yet, but maybe one of you will. So that's where, our focus is going to be to put this project into production, given how robust the economics are. Metallurgy is crucial for any project. We've done a tremendous amount of work over the last few years. We've completed over 390 tests to date. We're using 81.8% in our study. We've completed over 20 column tests so far. Average recovery on those column tests is 91.7%. We then went and completed 2 bulk scale 15-ton pilot tests. After 60 days of leaching, we averaged 91.9%. So again, that further validates all of the column test work and should give all of you a lot of confidence in terms of the the work that's been put into this PEA. So I'll talk about infrastructure now. So from an infrastructure perspective, we've got very good infrastructure. So we've got a paved road and power line that goes right through our project to the town of Enchi. Enchi's got about 15,000 people, so it's got all the support services we could want. It's got, elementary schools, hospitals, high schools, and importantly, we can house all of our employees here in the town of Enchi. So we're not having to build, $50 million camps in the middle of nowhere. It also sits about 15 kilometers away from where the processing facility will be, so no issues when it comes time to building the project. This highlights the infrastructure. You can drive 100 kilometers an hour along that road. There's a power line that runs beside it, gas stations, cell phone towers. You then drive 15 minutes down dirt, gravel, logging roads. So throughout our project, you have dirt and gravel logging roads. So you drive down here, you're standing on top of our Boeing deposit. Another 10 minutes from there, you're standing on top of our Sium deposit. And then tucked into a valley right in between those two is our heap leach facility. So 80% of the material coming from those two deposits. And then within 7 to 10 kilometers, you've got Niam and our Quachikrum deposits. To give you a sense of, the climate and topography, this is what it looks like. So low-lying hills. This is all second, third generation forest. So it's all been, forested in the past. And again, throughout the project, we then get dirt and gravel logging roads. So all of that contributes to the lower capex that's required for the project. So those are the economics of the PEA. Again, I see a fundamental re-rating in the stock as the market starts to properly price in the value of our Enchi project, and we're aggressively going to move it towards production. But in terms of exploration, we've also got district scale exploration that still exists across our project. If you look at where we're situated, you have 2 prolific belts in Ghana. You've got the Ashanti belt and then the Sefwi Bibiani belt. To the north of us, you've got Chirano, Bibiani, historical endowments of 5.5 and 6.5 million ounces. You've got Newmont, who's putting another $1 billion into their Ahafo project, which sits along the belt from us to the north. In terms of the project, it's a large land package, 248 square kilometers in size. We've identified over 25 targets to date, of which we've only drilled on 9 of them. This is our 248 square kilometer land package here. As I mentioned, all of our existing deposits, this is our largest deposit, Seum, followed by our Boeing deposit. All of them remain open along strike. So systematically stepping out, we've identified some new structures and continuing to add near surface material to put on the heap leach to extend mine life over time is something that we will continue to do. And then the other thing that we're excited about is the opportunity at depth. So we will add near surface ounces, and over time, we will then start to grow the underground resource. What we're looking at here is a long section of our Enchi project. We're then comparing that to the Chirano mine, and this would look very similar at Newmont's Ahafo mine. We've superimposed the average vertical depth of the pits that constrain our resource today, which is only down to about 75 meters. When you then compare that same level at Chirano, you can really see where a lot of these deposits grow in size and increase in grade as you start to identify these high-grade feeder zones. To put that in perspective, Chirano today is mining at roughly 800 meters below surface, 1.5 to 2 gram per ton material. So we've just started to scratch the surface at 75, and we've also started to put a few deeper holes into the project. We've got 136,000 ounces of underground resource today, which is obviously not a mine, but it's a proof of concept that we've got the ability to grow the higher grade underground resource as well. What we're looking at here is our Nyam deposit. So there's the pits that constrain the primarily heap leachable material that feeds our PEA. As we started to drill deeper, we hit 5.8 grams over 7, 5.6 over 8, 6.5 over 4, 5.5 over 9. So we've identified, one of these high-grade feeder zones. To the south, sitting 500 meters away, we've identified another high-grade feeder zone. To the north, a third one. So what this includes, this model, is every single hole ever drilled here. And as you can see, there's big gaps in the drilling. So that's the opportunity for us to go back, continue to drill deeper, and expand that high-grade resource. Importantly, we're still only at about 250 meters below surface there. In terms of Ghana itself, it's a tier 1 jurisdiction to have an asset in. It's Africa's largest gold producer. It's the 6th largest gold producer globally. So it's very important for the economy. It's important for jobs. But what we always say is, don't listen to me. I'm a biased CEO with one asset, but look at what the major companies are doing. You've got 3 of the top 10 largest gold producers in the world who've got significant operations in Ghana. Newmont is putting another $1 billion into that project that I highlighted that sits to the north of us. So it's a great jurisdiction for us to be operating in. In terms of capital structure, we're sitting at about 173 million shares outstanding today. We've got $3.3 million of warrants that are well in the money that have started to already come in. Those will be in by the end of June. And then another 3.7 million on the balance sheet at the end of December. We burn about $300,000 Canadian a month. So we're sitting around $6 million today, assuming all those warrants are exercised, which again, they're well in the money. Management and board, I highlighted, we're truly aligned with all of our shareholders. And then we also have tremendous institutional support, 45% institutionally owned today. Franklin Templeton would be our largest investor at about 10%. Pardon me, Rougher at about 7%, and a smattering of other institutional investors. So again, it's a company that's backed by a strong management team who's aligned with shareholders, and we see a tremendous re-rating opportunity as the market starts to price in the value of our Enchi project. Thank you very much.